The other driver owes you $1 million, but their insurance will only pay up to their $200,000 liability limit. They have to pay the other $800,000 themselves. But this is a person driving around underinsured. Do they have $800,000 in the bank? Not likely. What family protection does is allow you to use your own coverage to cover some of the damages that the at-fault driver's insurance would cover if they had it. If you don't have the family protection endorsement, you'd be relying on the uninsured driver to cover the settlement out of their own pocket. Settlements for serious accidents can be over $1 million, way more than the average driver has access to. And that's why family protection coverage, also known as OPCF 44R, is important. Most of the time, you don't have to pay much or anything if you're in a car accident and someone else is completely at fault. Your car insurance would cover damage to your vehicle and your medical costs. The at-fault driver's third-party liability coverage would pay any other costs for which they're liable. That includes damages for things like pain and suffering, or certain other things not covered by your own insurance. But many drivers carry only the legal minimum in third-party liability coverage, which, in Ontario, is $200,000. And of course, some drivers have no insurance at all. And hit and runs are a thing too. So there are quite a few scenarios where an at-fault driver might owe you a lot, but there's no way for them to actually pay you. Enter family protection coverage. If you have it, you can use your own third-party liability limit to top up the amount that an underinsured at-fault driver owes you. As the name suggests, family protection coverage extends to your immediate family members as well. And you can even use it if you're partially at fault for the accident, just not if you're totally at fault. The limit of coverage is the difference between your third-party liability limit and the at-fault drivers. If it's still not totally clear how all of this works, keep watching. Say you've been in an accident with a driver who only had the minimum $200,000 in liability coverage. You've been badly injured, and it's the other driver's fault. They drove so poorly that they've been found liable for $1 million in damage. Now, example A, you don't have family protection coverage. The other driver owes you $1 million, but their insurance will only pay up to their $200,000 liability limit. They have to pay the other $800,000 themselves. But this is a person driving around underinsured. Do they have $800,000 in the bank? Not likely. You'll probably never see the rest of the money you're owed for your pain and suffering. So you're out of luck. But over here, in Plan B, you do have family protection coverage. Your own car insurance would cover that shortfall that the at-fault drivers does not. So after the same accident, if you had $1 million in liability coverage, it would cover up to that amount minus what the at-fault driver's insurance covers. Just enough to cover the missing $800,000. If you only had $500,000 in liability coverage, it would cover up to that amount. $500,000 minus the $200,000 covered by the at-fault drivers gives you $300,000 worth of coverage here. So alongside your family protection coverage, make sure you got high enough liability coverage. Most insurance providers recommend $1 million in third-party liability coverage, if not $2 million. Now, hopefully, you can see why this little endorsement comes so highly recommended. Have I mentioned that it usually only costs a few dollars a year? And that policies from Square One include it by default? To get a car insurance quote from Square One, just visit squareone.ca or click the link on the screen. And make sure to hit subscribe to stay up to date with new insurance tips and guides. Thank you for watching, and I hope you found this helpful. OPCF 44R, also known as OPCF 44R, also known as OPCF 44R.